The Intelligent Investor by Benjamin Graham. Detailed summary. 1. Introduction. Benjamin Graham's The Intelligent Investor is considered a cornerstone of value investing. This book, originally published in 1949, offers timeless wisdom and strategies on how to invest intelligently. Graham distinguishes between investment and speculation and argues that successful investing is more about character than intelligence. 2. Investment versus speculation. Graham emphasizes that investing is based on thorough analysis, safety of principle, and an adequate return. Speculation, on the other hand, involves higher risks and is based on price movements rather than intrinsic value. The book warns against speculative behaviors and urges investors to recognize their approach. 3. The concept of margin of safety. A recurring theme in the book, the margin of safety refers to buying securities when they are priced significantly below their intrinsic value. This concept protects investors from unforeseen market declines and mistakes in analysis. 4. The role of inflation. Graham discusses the impact of inflation on investment strategies and emphasizes the importance of protecting purchasing power. He evaluates how different asset classes, like bonds, stocks, and inflation-protected securities, respond to inflationary pressures. 5. Mr. Market analogy. Graham introduces the fictional character, Mr. Market, to explain market fluctuations. Mr. Market offers to buy or sell stocks at different prices every day. The intelligent investor does not follow Mr. Market's mood swings but instead uses them as opportunities to buy low and sell high. 6. The defensive versus enterprising investor. The book defines two types of investors. Defensive investor seeks safety and a passive, long-term investment strategy. Suggested allocations include high-grade bonds and blue-chip stocks. Enterprising investor, willing to devote time and effort to research and manage investments actively. Graham suggests that this type must have discipline and a clear strategy. 7. Stock selection for the defensive investor. Graham advises defensive investors to focus on large, conservatively financed companies with a long record of dividend payments. Diversification and low portfolio turnover are key principles. 8. Stock selection for the enterprising investor. Enterprising investors are encouraged to look for undervalued stocks using techniques such as financial statement analysis. Strategies include purchasing unpopular large companies or bargain issues below book value. 9. Market fluctuations and investor psychology. Emotional control is crucial. Investors should avoid reacting to short-term market noise. Overreaction to news and fear-greed cycles often lead to poor investment decisions. 10. Security analysis. While Graham co-authored Security Analysis, he includes simplified versions of the techniques in this book. Key points include analyzing earnings stability, financial strength, dividend records, and intrinsic value. 11. Investment funds and advisors. The book discusses the advantages and drawbacks of mutual funds and investment advisors. Graham encourages investors to be cautious and well-informed when relying on professionals. 12. The history of stock market performance. Graham presents historical data to show how markets perform over time, emphasizing the value of long-term investing over speculation or market timing. 13. Real-world examples and case studies. Several chapters are dedicated to case studies, comparing companies and analyzing outcomes based on Graham's principles. These serve as practical demonstrations of his strategies in action. 14. The role of bonds and fixed income securities. The book includes guidance on investing in bonds and notes that these should be a significant portion of a conservative investor's portfolio. Graham stresses credit quality, maturity length, and interest rate sensitivity. 15. The investor and corporate behavior. The investor should consider management's behavior and policies, especially concerning dividend policy, use of debt, and corporate governance. 16. The importance of temperament and discipline. Perhaps the most profound insight is that investing success is more about temperament, patience, discipline, emotional detachment, than intelligence or advanced knowledge. Conclusion. The Intelligent Investor continues to be a relevant and essential read for anyone seeking to build wealth through the stock market. It advocates for rational thinking, long-term strategies, and a grounded understanding of value. Graham's teachings have influenced generations of investors, including Warren Buffett, who calls this book the best book about investing ever written.